Hello, everyone, and welcome to the Cannabis podcast, the show that helps cannabis companies manage their costs and tax liabilities through tax planning and proper cost accounting. I'm your host, Desiree Anderson, certified public accountant and enrolled agent at Tax and Accounting Strategies. I specialize in cannabis, CBD, and hemp tax and accounting. I chose to specialize in the cannabis space because of my long-term expertise as a tax and financial auditor. As a former government tax auditor, I saw the types of mistakes businesses made from a tax perspective, which led me to want to help cannabis business owners and CEOs stay under the taxing agency radar. As a former financial auditor, I know the importance of a financial electronic audit trail. Such a trail gives investors, lenders, and valuation experts the confidence that they need to make financial decisions beneficial to your business. Thank you for tuning in, and I hope you enjoy the show. Hello, everyone, and welcome back to the Cannabis CFO podcast. I'm your host, Desiree Anderson. On today's show, I'm going to be talking about the albatross around the neck of the cannabis industry, also known as 280E. I'll also be discussing the concept of apportioning certain 280E expenses to non-cannabis activities, as well as items that can be included in cost of goods sold based on the type of cannabis business you operate. Now, 280E is an IRS code that is only a few sentences long, but packs a huge punch within the cannabis industry as it relates to tax-deductible expenses. Now, 280E disallows all deductions and credits that are normally allowed for businesses that do not traffic in controlled illegal substances, which pretty much is every other business. Okay, now 280E was first enacted in 1982 for the purpose of overturning the result of a tax court case involving someone by the name of Jeffrey Edmondson. Now, Edmondson was in the business of trafficking in controlled substances, which is prohibited by federal law. Now, according to federal law in the year 2020, marijuana is still considered a controlled substance. Therefore, it is still illegal. Now, Edmondson was fighting to allow deductions that he incurred in his business, which included telephone, auto, and also rental expense. Now, this is a case that actually solidified the fact that normal business operating expenses cannot be deducted by cannabis businesses, as well as other businesses that traffic in Schedule I narcotics. Now, the consequence of this is a very high effective tax rate, which could wipe out the entire profits of any business and pretty much leave it in the red. The only bright spot to 280E, that's if you can even find a bright spot, is that it doesn't affect cost of goods sold. Now, luckily, Congress didn't attempt to prevent taxpayers from taking cost of goods sold into consideration when computing gross income. And the reason for this is because cost of goods sold is viewed as a capital investment, which means the investment has to be subtracted from the total sale of the products before your taxable income can be determined. So let's use a home or a house, for example. Let's say you purchase a house for $1,000, and then it costs you an additional $500 to actually fix the house up. Now you sell the house for $2,000. Well, before you can determine what your taxable profit is going to be, you have to first off subtract the $1,500 that it costs you to bring the house to market, which of course leaves you with now $500. So when you're determining your tax liability, you're going to determine it based on the $500. So you're always allowed to subtract your investment in any business before you determine your tax liability. So the same thing applies to the cannabis industry. So as you can see, it's extremely important that you pay particular attention to your cost of goods sold for this very reason. You want to make sure that you work with accounting professionals that are very well versed in cost accounting for the cannabis industry in particular, because this could be the difference between your business surviving until cannabis becomes federally legal, or your business from failing as a direct result of 280E. Now, because of the restrictions that 280E places on the cannabis industry, it's important for operators, investors, and financial professionals that work within the industry to understand the federal tax limitations that affect the cannabis industry's overall profitability due to federal tax law. Now, furthermore, understanding what's allowed as a part of cost of goods sold for a cultivator or a manufacturer compared to a dispensary or a retailer is important, because cost of goods sold, as you're going to see, or as you know, is not created equal across all cannabis industry types. Whenever accountants like myself try to determine what is and isn't tax deductible, we look to the two main sources that answer that question: statutory law and case law. Now, statutory law is created and passed by the legislative branch of the government, while case law is law that is based on judicial decisions passed down by the courts. For example, the Edmondson case that I just talked about would be considered case law. Now, in an attempt to navigate 280E, there is sometimes confusion around whether 280E expenses can or cannot be apportioned to non-cannabis sales. I don't think, and I could be wrong, but I don't think that there is a statutory law that clarifies this issue. However, there are a couple of legal cases that made it clear if and when operating expenses can be apportioned to non-cannabis sales. Now, the effect that 280E has on the profitability of dispensaries and retailers leads some operators and accounting professionals, don't forget, to find ways around the 280E deductible rule. One of the strategies used to try and circumvent 280E is to introduce the sale of non-cannabis products. Now, these non-cannabis products are then sold within the same cannabis business in the hopes that a portion of 280E expenses can be apportioned to non-cannabis sales, thereby allowing for the apportioned amount to be deducted as operating expenses on the tax return. Now, why this strategy may not work for some businesses is because merely selling non-cannabis products within a cannabis business does not automatically nullify the 280 rule. So in order to actually apportion operating expenses to non-cannabis activity, there has to be two or more separate trade or businesses involved. Keep in mind, and people get confused about this, that merely performing two or more activities under one business doesn't qualify as two or more separate businesses. All this means is that you have a single business that provides two or more services or sells two or more products to your clients. It doesn't mean that you have two businesses automatically, okay? Just like in my business, for example, as an accountant, I sell IRS representation services to clients, and I also sell financial statement cleanup to clients, okay? Now, if I decided to start selling books that I wrote, accounting books that I wrote to clients, it doesn't necessarily mean that I have created a totally separate business. All that really means is that I have I now sell more than one product to my clients. So it's really important that you understand this and that you keep it in mind. Now, some people believe that if they create a separate entity for the purpose of selling non-cannabis products, that they are allowed to apportion deductible operating expenses to that second entity. This premise also does not hold if all the entities are part of a unified business enterprise with a single profit motive. Now, you must understand that, okay? Now, tax court settled this issue in two cases. One is Champ versus Commissioner, and the second one is Canna Care Incorporated versus Commissioner. Now, in Champ, the courts found that the taxpayer operated two separate trades or businesses, one that provided caregiving services and one that sold marijuana. Therefore, the courts required the taxpayer to allocate its expenses between its two businesses according to the number of its employees and the portion of its facilities that was devoted to each business. So because of that, Champ was allowed to deduct the expenses that it properly allocated. Keep in mind, properly allocated, which means that they are keeping books. They're making sure that they're doing cost accounting so they can properly allocate these expenses. So in other words, they were allowed to deduct the expenses that they properly allocated to their caregiving business, but they were not allowed to deduct the expenses that were allocated to its marijuana sales business. Conversely, in Canna Care, the court found that the taxpayer, which stipulated that it was in the business of distributing medical marijuana, was engaged in only one trade or business because its sale of non-marijuana items like books and socks was an activity incident to its business of distributing medical marijuana. Therefore, the courts held that Section 280E banned the deductions for any of its business expenses. All right, so you can see in one case, the courts allowed the allocation of operating expenses merely because there were two trade or businesses involved, unlike the second case that operated only one business, and therefore they were not allowed to allocate any expenses to the non-canna sales of their products. Now, it's very important that you understand this concept, because what you don't want is for the IRS to audit you, then deny expenses that you were not allowed to deduct in the first place. Now, let's move on to cost of goods sold, what's included in cost of goods sold, and why cost accounting matters in relation to cost of goods sold. Now, as I mentioned earlier in the podcast, while the legislative branch was busy writing law to make sure that drug trafficking businesses were denied the ability to deduct operating expenses, it has made it clear that businesses that traffic in controlled substances are still allowed to reduce their total sales by cost of goods sold. Now, the law was affirmed in a case by the name of Olive versus Commissioner, where the court noted that under the Internal Revenue Code, the business was allowed to deduct from its gross income all of the ordinary and necessary expenses paid or incurred during the taxable year in carrying on the trade or business, which essentially means that the cost of bringing a product to market is deductible. So cost of goods sold is one of the very few financial mechanisms that cannabis businesses have to try and control how much they pay in federal taxes. Equally as important is knowing and understanding what can and cannot be part of cost of goods sold in general, and what can and cannot be part of cost of goods sold based solely on the type of cannabis business that you operate. Now, retailers and distributors are required to use Internal Revenue Code Section 471-3, while cultivators and manufacturers are required to use 471-11. So let's break this down a little bit more. Retailers, unfortunately, don't have as much latitude when calculating their cost of goods sold. They pretty much are limited to the net cost of the product, net cost meaning the total cost of the product minus any discounts that have been applied to the total cost. Additional costs allowed are things like transportation to get the products from the vendor to your retail establishment, and other necessary costs that are incurred in acquiring the product. Now, there is also another IRS code section called 263A that does allow for additional indirect costs that retailers incurred to be capitalized and added to inventory and deducted as part of goods sold. Now, these additional costs can be derived from things such as service costs, that would be general and administrative expenses, for example, as well as depreciation and other types of costs. However, 263A does not apply to cannabis retail businesses. And this is because the law says that if in the normal course of business, a company is subject to 280E, which of course we know cannabis companies are subject to 280E, the company is equally not allowed to capitalize those same 280E expenses and deduct them as a cost of goods sold at a later date. So in short, I'm going to read to you what Congress concluded. So here it is. Under Code Section 263A, capital A, in parentheses, small a, resellers and producers of merchandise are required to treat as inventoriable costs the direct cost of property purchased or produced, respectively, and a proper share of those indirect costs that are allocable to that property. Now, any costs, this is where we need to pay attention. Any costs which, but for this subsection, which I just read, could not be taken into account in computing taxable income for any tax year, shall not be treated as a cost of goods sold described in this paragraph. So pretty much that's pointing back to cannabis industry, letting us know that the costs for a cannabis retailer cannot be deducted despite this subsection, okay? So what this means is 263A does not apply to the cannabis retail industry because if this subsection didn't exist, cannabis retail businesses wouldn't be allowed, or rather wouldn't be able to deduct the costs in question. So therefore, they cannot deduct them just because of Section 263A. Okay, so now that we've discussed that, let's move into the manufacturer realm. Okay, so cultivators, producers, and manufacturers are able to include a lot more of their costs in cost of goods sold simply because by the very nature of their business, it costs a lot more to bring their product to market. Now, cultivators and producers are required to use IRC, which is Internal Revenue Code 471-11, to determine what to include in costs of goods sold. Now, in order for producers to conform as close as possible to the best accounting practices, income must be clearly reflected in their financial statements. So in order to achieve this goal, the full absorption method of inventory costing has to be used. And that's because full absorption costing takes into consideration both direct and indirect production costs when computing inventoriable costs. Okay, so what are direct costs? So direct costs include all of the material and items that you need to grow your crop, like seeds, plants, clones, pesticides, nutrients, fertilizers, and whatever else you use to actually grow your crop. It also includes direct labor, which is labor that can be directly identified or associated with the production of units or groups of units. So if you can actually trace that direct labor right back to the crop, then that will be considered a direct cost. Indirect costs, on the other hand, can be either fixed or variable. Now, indirect fixed costs don't vary significantly with changes in the amount of goods produced. These costs include things such as rent for your production facility, property taxes on your production building, and machinery that is incident to or necessary for manufacturing, producing, or processing your products. And of course, indirect labor, which includes supervisory wages. Now, indirect variable costs usually vary significantly with changes in the amount of goods produced at any given level of production capacity. Indirect variable costs include indirect materials and supplies like grow supplies and packaging, utilities, which will include water and electricity that's used to grow your cannabis, maintenance costs for your machinery, and the cost of your production and storage facilities used for your product. Okay, so all of the indirect costs that I just mentioned are deductible as costs of goods sold if they are related to the production of your cannabis. In addition to those costs, so in addition to the costs that I just mentioned, manufacturers and producers and cultivators are also entitled to additional deductible expenses if the business prepares its financial statements in accordance with generally accepted accounting principles, which is also known as GAAP for short. So unlike dispensaries, cultivators and manufacturers produce cannabis from seed to flower. So some of the expenses that they incur under GAAP reporting can be included in inventory as indirect costs. These costs are capitalized only to the extent the taxpayer capitalizes them for financial reporting purposes. So as you can see, once again, it's important to make sure that you are keeping your books properly, doing proper cost accounting, and also proper GAAP accounting. So some of these costs include property taxes on manufacturing equipment, depreciation or depletion of manufacturing equipment, employee benefits to the extent that they are related to production labor. So you see how intricately you have to maintain your books to be able to get all this information correct and get them properly allocated. Also, you have costs related to strikes, rework of labor, scrap and spoilage, administrative costs attributable to the manufacturing process, office salary allocable to production activity, and insurance costs that are also allocable to production activities. All right, so from our discussion so far, or should I say from our discussion today, I truly hope that I've helped you understand the importance of doing both cost and GAAP accounting for your business. Now, I mainly discussed all of the benefits as it relates to reducing your tax liability. However, keep in mind that maintaining proper accounting records under GAAP has many, many more benefits other than those for tax purposes. Your financials will always be financial audit ready. They will always be tax audit ready, and they will always be investor ready. So in the long run, you're going to be saving money and time if and whenever the business needs to deal with a third party, which is extremely important, because if you are thinking about selling your business at some point, you want to make sure that you have pristine financial statements. That way, the investors who are coming in, or whoever is looking at your financial statements, who is looking to buy the business, they can clearly see what's going on in your business. And they cannot do that if you have not properly kept your financials, and not just properly keeping them in proper form, which would include using cost account, or rather gap accounting, to maintain your books, and also making sure you're doing proper cost accounting. So in order for you to actually achieve these two goals, you want a person, or you want to deal with an accountant that is very familiar with not only gap accounting and not only cost accounting, even though those two things are a must, but you also want to make sure that they are familiar with the cannabis industry, because the cannabis industry is not a little bit, I should say it's a lot different than other industries. So if you hire somebody who has knowledge with cost accounting and gap accounting, but they don't have knowledge with the cannabis industry, then you are going to subject yourself to, I would say, issues down the road, because the cannabis industry in and of itself has its own laws, regulations, and quirks and nuances that only individuals who are familiar with this business understand. Okay, so you want to make sure you have all three parts. You want to have a person that knows cost accounting, who understands gap accounting, and who's also well steeped in cannabis accounting. Okay, well, that's all I have for today. Thank you for joining us this week on Geo-Cannabis Accounting. Make sure to visit our website at geotaxandaccountingstrategies.com, where you can subscribe to the show by clicking on the podcast tab so you'll never miss a show. While you're at it, if you found value in this show, we'd appreciate a rating on iTunes. Or if you'd simply tell a friend about the show, that would help us out too. I am also available to help cannabis business CFOs, investors, and other accounting professionals with tax planning, gap accounting, as well as cost accounting. Please don't forget to tune in to our next episode. And this is where I sign off.